Hi, I'm Elisa Zhang, and I am a physician as well as a life and money coach. So what is an accredited investor? The definition of an accredited investor is someone who makes $200,000 a year for the last 2 years and is likely to continue making $200,000 a year, or a couple who makes $300,000 a year for the last 2 years and is likely to continue making $300,000 a year, or someone who has $1 million of investable assets, which basically means a net worth of $1 million, not including the equity in their primary residence. And so what does it mean if you are a credit investor? Well, there are a lot of investment opportunities that are out there for people who are classified as a credit investor that aren't available to the general public. And that's because the SEC has basically determined that if you've got enough money that you could put money in these investments and it's not going to substantially impact your financial life if you lose all that money, then you can go ahead and invest in those kind of investments, essentially. And so what kind of investments are there? Well, there's different syndications, like real estate syndications. There is venture capital. There's hedge funds. There's private offerings. So actually buying into a business before it becomes a publicly traded business. So basically, like you're buying stock in a business that's not publicly traded, you're buying a percentage, it may be small, it may be large, of that business, but it's not actually publicly traded. So you're buying it pre-IPO, and the hope is that when it does IPO, that you get paid out, or a bigger company buys that company, that you get paid out for your ownership in that company. So we can talk a little bit more about each of these things. So syndications, sometimes when I talk to people about syndications, they say that usually associate that with a crime syndicate. Well, a syndication is really just a group of people working together for a singular purpose. And a syndication is often used for real estate syndications, where a bunch of real estate investors come together and tackle a real estate investment. So when you think about those big apartment complexes, big commercial buildings, even things like hotels, there's usually not just like one investor who's doing it. It's usually done through a company, often an LLC, and there will be someone who's kind of running the business operation. And you should really think of most real estate investing as a business. And so there's going to be someone who, let's just take the example of an apartment complex. They find an apartment complex that's being sold at a favorable sale price. And then they secure the financing, but they still need some down payment, right? 20, 25, 30% down payment, depending on the loan. And so the syndicator or sponsor is going to do all the kind of management of the real estate investment. So they're getting the loan, they're negotiating the terms of the contract, they'll be finding a property management company to run the property management, or they may be property managing themselves. They are doing the renovations to force appreciation and raise rents in the apartment complex. And so they're going to really do all the actual legwork. But they need, again, that initial down payment as well as potential money for renovations until there is a positive cash flow that's covering all these things. And so then they go out and find other investors to invest with them. And so they may have a minimum investment of $25,000 or $50,000 or $100,000 to actually be part of this syndication project. And so you, as a passive investor, if you're a credit investor, can now actually invest into that syndication project, and then you get some ownership in that business that's owning that real estate, that apartment complex, as well as all the operations of it. So why a credit investor? Well, in order to actually, for these syndications to advertise, in order to find investors to actually invest with them, they have to follow specific rules. And one of those specific rules by the SEC is that they can advertise, but they have to check that someone is an actual credit investor. And again, this is something that SEC has done to kind of protect investors. And so if you qualify for as a credit investor, then these type of options are open to you. There's also two other investor classifications. There's the qualified client and the qualified purchaser. So for a qualified client, you have to have a net worth of $2.1 million of investable assets, so not your primary residence. And then for a qualified purchaser, you have to have $5 million of investable assets. And then for a qualified client, you can also have $1 million of money, assets, whatever, invested with one particular investment advisor, and that investment advisor is making these different investment choices for you that require you to be a qualified client. So these are just higher tiers of when you can actually get into certain type of investments. And what matters for these different ones is how much filing they have to do with the SEC, how much more kind of scrutiny they have to do. So when you have a publicly traded stock, for example, they file through the SEC and they have to do a lot of financial reporting. They have to send in quarterly reports and annual reports, as well as have independent accounting and auditors actually look at their books. So there's a high standard in order to become a publicly traded stock. And so there's a lot of expense to that. And when you think of something like a real estate investment, of buying an apartment complex, then if they were to do all those filings, then that would take a lot of time and take a lot of money. And generally with these real estate projects, you have to kind of move faster than that. So that's why using money from accredited investors or these other classifications can really kind of be more nimble, and because they're avoiding some of the costs, theoretically they can pass on some of those the lack of cost to more profit, pass it on to their investors. Whereas like a REIT, a real estate investment trust that's publicly traded on the stock market, they are filing all these things. So you're kind of losing some return in terms of the expense it takes for all these filings. And so that's why a REIT is typically going to have a much lower rate of return than a well-run syndication project or like a real estate fund that may have the same kind of investments that a REIT has, but not doing all those financial filings and just being more nimble with their investments. So the benefit about a REIT, of course, is not only do they do all these additional filings, so theoretically maybe a little bit more safer, a little less fraud, but you can get your money in and out whenever you want because you can sell the shares on the publicly traded stock exchange. Whereas when you buy into a syndication, once you've invested in it, you basically have to wait for your money back until the sponsors either refinance and get that money back and can return it to you, or you're getting cash flow over time, or they go ahead and sell the property and have all the proceeds of the property, and then you get your return on investment. So hope this information is helpful for you. And this is why, the world of investing is actually much larger than stock and bond portfolios. Now, you don't have to actually venture into these alternative investments, but if you do have a lot invested in stocks and bonds and you'd like to have more diversification, this is certainly a way that you could diversify your portfolio. And again, my website is growyourwealthymindset.com. If you'd like to learn more about me, I do money coaching, mostly for physicians, but if you're not a physician but would like to work with me, reach out anyways. We can see if it's a good fit and whether I can help you. And one of the things I do help people do is decide whether or not they want to actually start looking at these alternative investments, what type of alternative investments would fit their risk profile and how much money they want to invest in there. And that might even be in contrast to things like active real estate investing, where you don't have to be a credit investor or any of these other classifications. Anyone can be an active real estate investor, but of course there is more due diligence and work on your part when you're an active real estate investor. Now, there's due diligence in all these investments. You always want to actually do your due diligence, make sure that the people you're investing with really know what they're doing, really it's a sound investment, that if this fits your timeline and your risk tolerance and all those things. So those are all things that we can talk about and coach through. And if you'd like to learn more, again, my website is growyourwealthymindset.com. I also have a podcast. So if you're enjoying these videos, the podcast has a lot of more in-depth information. They're a little longer, but you can listen wherever you are instead of having to necessarily watch a video of me talking. So anyway, thanks for watching.